Hello everyone and welcome to Ticker.com's news channel on YouTube. On this channel, we review stock markets, discuss financial news, market trends, and economic data from Wall Street to Global Street. So let's dive in. Today we are going to focus on what is happening in the UK housing market. UK economy has been struggling in the last 5 years, and the pandemic and Ukraine war only made things difficult. Housing market is a critical pillar of the UK's economy, and what happens to the housing market affects many other related and non-related industries. So it is important to understand what forces are driving the housing market, who is likely to face the brunt of the higher mortgage rates, and what are likely contours of fast-evolving crisis. How likely is the so-called mortgage bomb, where home prices are heading, and how high mortgage payments are likely to go. Let us find out answers to these questions. I've divided this presentation into 3 segments to get a better understanding of the UK's housing market overview, interest rates and mortgages, and building societies. Let's start with the housing market overview first. UK and London home prices have been on the rise and demand has outstripped supply for years. Despite rising home prices, near 0% interest rates for a decade made homes affordable for many in the UK. Home prices have tripled since the beginning of this century, and more recently, average home prices jumped between 15 and 30% depending on the home type between 2020 and 2022, meaning in the last 3 years alone. In other words, home prices have been on a tear, reflecting worldwide trend. But despite higher home prices, mortgage repossessions have been very low, even by historical standards. Home price to income ratio have been rising because wage gains are lagging. Median home prices in London is now over £500,000, about 9 times annual gross income. There are about 28 million households in the UK. About 65% of the homes are owner-occupied. Of the 15.6 million homes, about 6.8 million homes have outstanding mortgages, and the rest are owned free of mortgages. Including rental properties, about 9 million residential mortgages are outstanding in the UK. About 1/3 of homes are owned with no mortgage. Another third households have a mortgage, and the remaining are rentals. Most homeowners have a 25-year mortgage with a fixed rate between 2 and 5 years. Meaning at the end of the period of 2 or 3 or 5 years, these mortgages have to be reset and repriced. This is different from the US, where most mortgages are 30-year fixed rate mortgages with fixed monthly payments for the entire loan duration. About 1 million homes were sold in 2022 in the UK, of which about 250,000 were brand new homes. Let's shift our focus to interest and mortgage rates. As you can see on the next slide, the base rate set by the Bank of England came down sharply in 2009 and fell to near zero to revive the economy from the aftermath of the previous crisis, subprime crisis. Despite the rapid decline in interest rates, mortgage rates stayed near 4% and fell in smaller decrements, but the decline in mortgage rates lagged considerably to interest rate. Mortgage rates finally dropped near 2%, or rather towards 2%, when interest rates stayed near 0% for many years, meaning mortgage rates were higher than interest rate between 2% and 3.5 percentage points, and banks and other lenders were making a lot of money by selling mortgages. However, things began to change after the Brexit vote and COVID-19 pandemic. The pandemic-era supply chain disruptions catalyzed goods inflation, and Ukraine war fueled inflationary forces further to unprecedented level in recent history. With the cost of imported food and energy rising sharply, inflation soared about 10%, forcing the Bank of England to lift its rate starting from 0.1% in December 2021 to 5% today, a big jump. Higher interest rates pushed up all rates, including mortgage rates, and the rates began to rise at a faster clip, catching most mortgage borrowers by surprise. Despite rate hikes, interest rates are still lagging inflation and not restrictive enough, meaning interest rates are not high enough to curb economic activities and cool inflation. Inflation in June of this year was 8.7%. Core inflation was 7.1%, but bank rates are still 5%, meaning rates are still lagging inflation by a wide margin. Most economists are expecting the Bank of England to lift current base rate of 5% to 6.25% by the first quarter of 2024. Rates may have to stay at elevated level for at least additional 6 months before the Bank of England has the flexibility in lowering rates. Mortgage rates last week stayed above 7.2%, and rates are likely to climb following higher interest rates in the months ahead. If spread between mortgage rates and interest rates hold at 2%, then mortgage rates are likely to peak around 8.25% in early 2024 and could stay there another 2 quarters or longer. This will not be good news for many homeowners who are looking to refinance their loans in the future. Building societies, which provide mortgage loans to about 1/3 of new mortgages, will be also impacted because their chief source of funding is now replaced with deposits that require higher interest rates to attract customers. We will talk about building societies later. The Bank of England Stability Report last week estimated about 4 million loans are expected to be refinanced between now and the end of 2026. Of these mortgages, 1.8 million are expected to be refinanced by 2024, meaning next year, and about 800,000 by the end of 2023, meaning this year. Moreover, at least 1 million homeowners are estimated to face higher monthly payment of £500, and about 2 million are likely to face an increase of average £220 in monthly payments. Stability Report also estimated that about 2.3% of all households, or 650,000, are likely to face financial pressure from rising rates by the end of the year. The Bank of England estimated in the report that despite the current fast-developing mortgage crisis, fewer households will be affected when compared with the last crisis in 2008 and 9. About 3.4%, or about 870,000 households, faced severe financial crisis during the last mortgage crisis in 2008 and 9. In fact, subprime crisis could be replaced with subprime crisis, where a borrower could do everything right and still be hit because he or she did not mortgage duration long enough. Things can get uglier for more households in a hurry. If mortgage rates stay above 8% and the UK economy dips into shallow or deep recession, forcing more people off payrolls. This double whammy of higher rates and rising unemployment will certainly cause more financial hardship to a larger number of households. Likelihood of interest rates peaking near 7%, beyond the current expectation of 6.25%, is rising with each passing day. Because longer the Bank of England takes in lifting rates to the level that are restrictive to the economy, rates will have to stay higher longer in bringing down inflation. We estimate that if rates peak closer to 7% and stay there for another 2 quarters, about 1.2 million or 4.5% of all households could face severe financial stress. Another important metric to keep an eye on is core inflation. Core inflation, which excludes volatile energy and food prices, is a better measure of long-term inflation trend, and that trend is not good. Core inflation in May accelerated for the 3rd month in a row and rose to 7.1%, the level last seen in 1992, and way above the central bank's target rate of 2%. This suggests that the Bank of England has 2 choices: go slow and increase rates in small increments of 25 basis points and risk higher inflation for longer, or raise rates in larger increments of 50 basis points and push economy onto the brink of a recession. If stubborn core inflation does not drift closer to 2% soon, interest rates may have to stay at 7% for longer than 3 quarters, fueling demand for higher wages from workers, which in turn feeds into inflation. Pick the scenario you like. Outlook for the mortgage rate is not bright, and the odds of mortgage rates reaching 9% are rising with each passing day. The Bank of England will have to revise estimates of distressed mortgages and households under severe financial pressure, and there is a higher chance that that number will surpass the previous peak reached during the subprime crisis of 2008 and 9. Subprime crisis could just be as severe as subprime crisis about 15 years ago. In that event, UK economy, or rather UK government, will force banks to find ways to keep homeowners in their homes by stretching payments to longer duration, or suspending principal payments, or seek other creative solutions. Housing market will remain in chaos. Home prices will remain under pressure, and households are likely to struggle with elevated mortgage payments for at least next 5 years. Even if home prices fall by 20% in the next 18 months, which is very likely, prices will still be at the level last seen in 2021, meaning the prices haven't fallen far enough. The downward pressure on home prices could accelerate if the economy dips into a recession. On a brighter note, household debts as a share of income is significantly lower than during the subprime crisis. But this time, UK is also facing a surge in energy, food, and transportation prices. On another note, fewer percentage of homeowners have a mortgage, about 37%, compared to close to 40% during the previous financial crisis in 2008 and 9. This means that fewer homeowners are likely to be impacted by higher mortgages or higher mortgage rates. There are no easy answers for this crisis, and the best answer is to pay off mortgage as fast as you can. But that is not always possible for most working families with children. What does this mean for the UK economy? Well, higher mortgage rates will take a larger bite from the disposable income, meaning less money available for discretionary spending. Inequality in income will rise following the inequality in wealth after the latest run-up in the housing prices. Higher rates and longer mortgage crisis will certainly keep the economy in low or no growth mode at least till 2026, and maybe for another year or two longer. Interest rates and inflation dynamics is just as challenging in continental Europe too. The rapid increase in home prices have been felt by renters and new home buyers all over Europe, especially in the last 3 years. As you can see in this slide, home prices to income ratio and rent to income ratio has also been rising all across Europe, but at a slower pace, barring a few Scandinavian countries. Most European countries have fixed rate mortgage rates with a longer loan duration of 10 and 20 years, which are more popular in France, Germany, Italy, and Spain. While rates are going higher in the euro area just as rapidly as in the UK and US, but its impact on most households will be muted, and new home buyers will bear the full brunt of higher rates for now. UK banking regulators, the Bank of England, and the Finance Ministry should be working in encouraging mortgage lenders to create a long-term or rather longer-term products with maturity of 10 years or 20 years, supported by a deeper market for mortgage securities. This will have future homeowners with longer rates and payment visibility and follow the prevailing trends in the continental Europe. A peculiar part of the UK housing market is building societies. These member-owned financial organizations provide services similar to banks, but rely mostly on their depositors for their funding and focus on providing mortgage loans. These societies are for the benefit of the local community and for the services of their members, more like mutuals, and do not have shareholders. Home loans are the main reason of their existence, and when deposit rates were near zero and mortgage rates were close to 4%, building societies had ample cushion to make money with wider interest rate margins. However, things began to change after the Brexit vote and COVID-19 pandemic. The distinction between banks and these financial organizations have been blurring in the past 2 decades. The number of building societies have shrunk from as high as 273 in the 80s to 43 with 26 million members, and the number of mortgage borrowers are still around 3.5 million. Just to put things in perspective, there are 357 banks in the UK, and in addition to the building societies, they serve about 9 million residential mortgages together. Higher interest rates mean higher mortgage rates, but also higher deposit rates. And since building societies rely mostly on deposits, cost of servicing these deposits are rising too. In other words, more consolidation in the industry, and there is a good chance that the number of independent building societies may drop to 33 by 2028 from the current 43. This will also reduce competition in the mortgage market, which may keep rates higher for longer too. In the next 2 slides, you can review the market share of some of the largest building societies in the mortgage market, with Nationwide leading the list among all societies. Let us know your comments and share your experience about the current mortgage market in the UK and Europe. We would love to hear from you. Thank you very much.